Well, I think what you've got here is that this cycle is basically saying is that this is the growth rate, if you like, or a measure of the growth rate of momentum in liquidity. And what those cycles largely do is to drive asset markets. So as that liquidity cycle picks up, the black line picks up, then what you're going to get is asset markets responding positively or favorably to that. Generally speaking, when that black line's going up, you find asset markets are performing well. When the black line is coming down, you tend to find that asset markets are performing poorly, or they'll correct. And that's really the nature of how liquidity works. Now, if you look at what's going on in the world economy, broadly speaking, what you would expect to see, or what you would look to, I should say, are two things when you're looking at risk assets or understand risk assets. The first one is, what is the flow of liquidity into the markets? So we're saying at the moment it's benign generally. I mean, there may be a small air pocket right now caused by the lack of collateral or falling collateral as the bond markets sell off. But I think that is limited. What we're really saying is that looking forward, central banks are going to come back and ease a lot more, put a lot more liquidity into the system because they simply have to. Okay, so that's number one. The other thing is inflation. If inflation comes down, that's normally a great heads up for risk assets to perform strongly. Risk asset markets like equities are very sensitive to inflation. They are much less sensitive than many people argue to bond yields, and that's been the sort of the fact that's derailed a lot of analysts who have been saying for a long time, longer than I can remember, that we're about to get an equity correction because the bond markets are selling off. That's never really been the case. What equities respond to is inflation and falling inflation. And there's a chart I can show you to demonstrate the importance of inflation, which is this chart here. And this is trying to demonstrate that inflation is coming down. And what I was arguing earlier on in the context of the different economic models, what you've seen in the case of the West is that you've basically had a double hit. Number one, you've got the supply disruptions because of the COVID crisis, which was a lack of supply, that bottlenecks and prices rose, often haphazardly, and they were quite volatile and sharp rises. And the other thing is there was an increase in demand because so much money was injected into the systems, money growth shot up, and demand basically was restored. So if you've got a lack of supply and a lot more demand, you're bound to get inflation. Now, what we've got going on right now is that demand is coming down because central banks have tightened, and the supply side has got its act back again together. And so what you're seeing is supplies coming forward. So you're getting this big reduction in inflation. Now, what this chart is basically showing is good news from an equity investor's perspective, because the red line is showing expected inflation according to in the US, according to the University of Michigan survey, their monthly survey. And that has come right down from where it peaked at, this is 1 year ahead inflation expectations, and it peaked at around about 5.5% last year. It's come down now to much lower levels of around sort of just over 3.5%. The black dotted line is showing our measure of the pass-through of inflation shocks, and that peaked in late 2021 at around about 32 months. So in other words, what that was saying was that an inflation shock basically would last almost 3 years. So if you've got a jump in inflation this month, it would reverberate through the pricing structure up to 3 years. That was clearly the highest figure that we'd seen since the late 1970s and the big inflation problem that the US had during that period that was ultimately arrested by Volcker coming into the Fed. That's tumbled. So we're now down to about 7 months and it's still falling. So these two measures are telling you that inflation is coming out of the system, and we're moving back, in our view, towards a generally disinflationary world. And if you look at the landscape, and a lot of economies, producer prices are now falling year on year. So all this basically says that inflation is out of the system. If that is correct, a correct judgment, then what you've got is, I think, a very good base for risk assets and equities on a medium-term view. And that's part of our strategy. So we think that those asset classes are good. If you broaden that out and you say, well, okay, let's add in the very fact that central banks have got to undertake a monetary inflation because the debt burden is so large, then what you're talking about is a monetary inflation on top, which means that risk assets like equities, things like precious metals, things like cryptocurrencies are definitely assets that investors want in their portfolios. They do not want bonds. Parcho, what I just said about bonds being okay for the next 12 months, they are on a carry basis, but you've got to face a longer term future of a monetary inflation, which is, I think, highly likely.